Let's start maybe with you, Jose, for kind of the setup as things are going for today. Big rate decision or indecision, I guess, whatever you want to call it. But there are a lot of moving parts that the Fed and every central bank around the world has to. But the Fed's probably the most important at this point. What exactly are they ruminating about? And how exactly will they treat that Fed rate decision in the coming months, knowing what they know with the war in Iran?
Great to see you, Dom. Well, first, we're looking to see if this oil thing is going to be a one-time shock or if it's going to have a lasting effect. We're hearing from the Trump administration officials. Folks are saying weeks, not months. Things are going to be over soon. That's what we need for inflation to come back into the twos. Right now, we're running at around 3%, Dom. Crude oil prices are up 42% year over year, and that's starting to work its way into the services and to some of the core PCE categories like airline fares. So we really need the Middle East conflict to subside for the Fed to be able to cut in the second half of this year. As far as other global central banks, Dom, they're starting to hike. We saw Australia, ECB, UK talking about going the other way as well.
All right. So if I could just follow up on that. Food and energy prices are volatile, which is why they are stripped away from core inflation figures. If those oil prices are going higher, it's also having an effect on the spending from other parts of the market, things that other people cannot spend as much on because they're spending more on fuel. So is there a weird effect right now where because oil prices are surging, we may actually see inflation easing in certain parts of the market because they can't spend on as much there as they are because of fuel prices?
There is a sense that there's less capacity, particularly when you have a K-shaped consumer. The lower end is going to have more difficulty maintaining their expenditures. But I think overall, if crude oil prices stay high, I do think that inflation, it doesn't really solve the inflation problem. It does bump it up.
All right, Nimrit, with all of that in mind, it's also very curious to think about how markets have been very orderly with regard to how they've treated what's going on, not just on the macroeconomic side with the Fed and inflation, but a full-blown war in the Middle East. How exactly do you read that? And has the market reacted appropriately, or is there possibly way more downside than we're pricing in right now?
Dom, the markets are so conditioned now for the taco trade. You know, just think about last year, we were living through Liberation Day and what happened in the aftermath. So yes, it feels like we should react to the higher oil prices, to what's going on in the Middle East with the conflict. But I think if you start reacting, just look at what was happening coming into this year. Huge rotation into defensive, huge rotation into broad-based sectors outside of technology. And then what we've seen since March, the beginning of the war, is the reversal of all of that. So if you start responding to this back and forth, what's happening in the political environment and geopolitical environment, you're going to get whiplash. So what the market, I think investors are doing is really taking a bit longer term view and saying, yes, there's this tug of war constantly between an oil shock, maybe a stagflationary environment, but we have to balance that versus a AI driven productivity boom. And, based on that tug of war, you kind of see that playing out on the market on a day-to-day basis, but that's what we're really seeing. And, all of this is yet to play out how it's going to impact corporate earnings, but early indications indicate that corporates find a way to be resilient and pass through these shocks, inflationary shocks. So the corporate earnings are expected to be generally fine. And with that, the markets are holding in.
So, Lee, I saw you nodding in agreement on some of those things. I saw you listening intently to what Nimrit was saying. From a financial advisor standpoint, given everything that we've seen, especially over the last few weeks, have you made any decisions about reallocation, rebalancing, just the idea that you would change a client portfolio given what's going on right now? Or to Nimrit's point, are we just looking more long term and maybe smoothing some of these market moves over?
So I'm going to say a little bit of both. So we are making some tweaks to client portfolios. For more than about 18 months now, we've been shifting the allocation away from U.S. stocks and more into international. For any number of reasons, we're going to continue to do that, not making any huge wholesale change, and not specifically because of the war in Iran, but we're going to continue to make some of those shifts. One of the things that I am a little concerned about, as Nimrit said, corporates, a lot more resilience. I'm beginning to worry about the resilience of the U.S. consumer. There are a lot of things that I'm hearing and seeing that give me pause in that area. My concern would be at some point here in the not too distant future, if things do not subside, that the American consumer says, I'm tired.
Now, Jose, Nimrit brought up the AI aspect of this whole thing. There will be an economic impact. We're already hearing lots of commentary about the workforce possibly being disrupted. We've already seen firsthand job cuts directly attributable to artificial intelligence. From an economist standpoint, how exactly does that play out in not just the economy, but by extension, what the market's going to read into it?
Well, I think that overall the productivity has helped to offset the weaker hiring that we've seen in the last 2 years, and that's been terrific. And it also helps to keep earnings quite buoyant as well. But to talk about what Lee was saying earlier, you know, earlier this year we were talking about a broadening trade. We saw the Dow Jones and the Russell really lead the gains of the year when the NASDAQ and the S&P were kind of flat. Now we've seen those benchmarks really give up those gains because of this rally in oil prices. So the economic reacceleration that we were expecting in 2026, based on the legislation, Big Beautiful Bill passed in 2025, is really at risk here in 2026. However, yesterday we did hear those AI commentary from NVIDIA CEO Jensen Huang, and that looks like, at least this morning, that's bolstering the AI trade. We're on track for a third consecutive day of equity gains.
Nimrit, is this AI trade going to outweigh what's happening in the Middle East?
You know, it depends on a day-to-day basis, right? So what the price of oil does, what's the latest news? We've seen that the oil price is down, the AI trade is back up. You know, it could reverse. It could easily reverse tomorrow. The one thing I would say, again, you know, back to Lee's point, right? It's the corporates versus the consumers. Consumers have been weak. You know, we just heard that Vanguard published a study where last year was record withdrawals from their 401ks. So consumer has been struggling. But what's been keeping this whole market afloat is the corporate spending, the AI spending. And we don't really see that changing in a much meaningful way going for the next 12 months.
All right. And really quickly, Lee, how exactly are you going to play this energy shock?
Well, quite frankly, what we've been doing in some client portfolios, because going all the way back to COVID, virtually every client we have has a position in Exxon. And so with what's happened this year, the last few weeks, we've been trimming our position in energy.